base case for transitory inflation remains intact. Our base case has been that the surge in inflationary pressures over the summer months to levels significantly above the US Federal Reserve's long-term 2% target is unlikely to be sustained into 2022. This scenario is so far consistent with the US inflation data for the month of July, which showed that many of the factors contributing to elevated inflation since the second quarter of 2021 have started to wane. Headline and core CPI rose by 0.5% and 0.3% month-on-month in July, versus 0.9% for both measures in the month of June. Reopening categories like airfares had surprisingly eased off in July as well, and shelter prices were also softer than expected. The bolstering of the case for transitory inflation helped to keep equity markets relatively calm. A calmer inflation outlook also means lower odds of a more hawkish than anticipated path of monetary normalization from global central banks. As a result, after the release of the July US inflation data, the nominal US 10-year Treasury yield fell 2 basis points to 1.337% and experienced a sharp move down to end the week at 1.286%. With the latest inflation and labor market data consistent with their base case expectations, the Fed stayed on script as Fed officials continued the pattern over the last month of priming the market for a taper announcement in the fourth quarter of 2021. Shortly after the inflation print release, Dallas Federal Reserve President Robert Kaplan said that the Fed should begin to taper its purchases of Treasury bonds and mortgage-backed securities in October. This is one of the most aggressive calls to date in a week of heavy Fed speak, where we heard several regional presidents calling for bringing forward the tapering timeline. Bottom line, although the taper announcement could come as early as the Fed's next meeting in September, we're currently leaning towards November and December, and a lot will depend on the strength of the labor market and inflation data for August. Regardless, we believe that the Fed's exit from quantitative easing would be gradual, between 8 to 12 months, which remains over the long term broadly supportive of risk assets, albeit with the scope for sharp short-term volatility.